Welcome to Future Epoch, where we learn more about our world. In 2009, a company that had existed for less than 2 years became one of the most talked about IPOs on Wall Street. It was a coffee chain from China, and it promised to do something extraordinary, dethrone Starbucks in the world's most competitive consumer market. Investors loved the story. They poured hundreds of millions of dollars into it. And then, in a single morning, the entire thing collapsed. This is the story of Luckin Coffee, the fastest-growing coffee chain in history, and the fraud at its core that cost investors billions of dollars in a matter of hours. To understand Luckin, you first need to understand the Chinese coffee market in the mid-2010s. Starbucks had been operating in China since 1999, but coffee remained a relatively niche habit in a country with deep roots in tea culture. Starbucks was premium, aspirational, and expensive by local standards. The market was real, but it felt like it was waiting for something more accessible, more Chinese in its delivery model, and far cheaper. That gap is where Luckin was born. Founded in 2017 by Lu Zhengyao, also known as Charles Lu, and Jenny Qian, who served as CEO, Luckin's entire model was built around mobile ordering, rapid delivery, and aggressive discounting. There were no cashiers and no queues. You ordered through an app, picked up your drink, or had it delivered to your desk. The model was frictionless by design, and the coffee was subsidized so heavily that it was nearly free during promotional periods. The strategy was not to build a sustainable business from day one. It was to grow so fast, so aggressively, that no competitor could catch up. Every metric was pointed at speed. Luckin opened its first stores in late 2017 and reached 2,000 locations by the end of 2018, a pace of expansion that most restaurant chains take a decade to achieve. By mid-2019, it had overtaken Starbucks in raw store count across China, with more than 2,900 outlets operating across the country. In May 2019, just 18 months after its founding, Luckin listed on the Nasdaq Stock Exchange in New York, raising approximately $561 million. The IPO was a remarkable moment. A Chinese startup had convinced American investors that it could fundamentally reshape the most established global coffee brand's most important growth market. Analysts wrote enthusiastically about first-mover advantage, about the rising Chinese middle class, about the power of the app-first model. The stock climbed. Momentum built. And behind the scenes, according to later investigations, the numbers were being manufactured. The fraud itself centered on sales fabrication. According to the SEC's 2020 charges and Luckin's own internal investigation, the company's chief operating officer, Jan Lu, along with other employees, had inflated the company's revenue by approximately 2.2 billion yuan in 2019, which translates to roughly $310 million. This was not a rounding error or an aggressive accounting interpretation. It was fabricated transactions, invented sales, and manipulated data fed into the company's financial reporting. The motive was straightforward. Luckin's entire valuation rested on its growth story. Investors were not buying the company's profits because it had none. They were buying the promise of future dominance. To sustain that promise, the numbers had to keep rising, even when reality was slower than the narrative required. The fraud might have continued for years, but in January 2020, an anonymous sender delivered an 89-page research report to the short-selling firm Muddy Waters Research. Short sellers profit when a stock falls, which gives them a direct incentive to find problems that the market has missed. Muddy Waters published the report publicly, flagging what it described as evidence of fabricated sales data, inflated customer metrics, and fundamental questions about the company's actual unit economics. Luckin initially denied everything. The stock wobbled but recovered. Many investors assumed the short seller report was noise, a competitive attack dressed up as due diligence rather than a serious allegation backed by evidence. Then, on April 2, 2020, Luckin Coffee issued a statement that almost no one expected. The company disclosed that its own internal investigation had confirmed the fraud. The COO and several employees had fabricated transactions worth approximately 2.2 billion yuan. The number matched almost exactly what the anonymous report had alleged 3 months earlier. The market responded immediately. Luckin's stock fell more than 75% in a single trading session, wiping out billions of dollars of investor value in hours. The collapse was so severe that trading was halted repeatedly throughout the day as circuit breakers triggered on the exchange. The aftermath moved on multiple fronts simultaneously. In May 2020, Nasdaq announced that it would delist Luckin Coffee from its exchange, ending the company's short and extraordinary life as a publicly traded American stock. In July of that year, Luckin filed for Chapter 15 bankruptcy protection in the United States to manage its foreign creditors while restructuring operations in China. In December 2020, the SEC charged Luckin Coffee with fraud in connection with the fabricated sales figures. The company agreed to pay a civil penalty of $180 million, one of the largest penalties ever imposed on a Chinese company by American regulators. American institutional investors, pension funds, and retail shareholders who had believed in the growth story absorbed billions of dollars in total losses. But here is where the Luckin story becomes genuinely complicated. In China, the company did not die. It restructured, replaced its leadership, and kept operating. New management renegotiated its debts, closed underperforming stores, and pivoted toward a more financially rational growth model. By 2022, Luckin had returned to profitability in China. By 2023, it had surpassed 10,000 store locations, making it one of the largest coffee chains in the world by outlet count. The company eventually listed on the over-the-counter markets under new ownership and continued expanding aggressively. The company that had been built on fraud was, in a meaningful sense, still standing and still growing. The Luckin coffee scandal reveals several important things about how modern capital markets work and how they can fail. The first is the danger of growth narratives untethered from reality. Investors in Luckin were not paying for a profitable business. They were paying for a story, and the story turned out to be, in significant part, a fiction. When a company's entire valuation depends on one metric continuing to rise indefinitely, the pressure to make that metric rise can overwhelm everything else, including honesty. The second is the structural challenge of cross-border listings. Chinese companies operating under Chinese law, reporting to American investors, and audited by local Chinese firms exist in a regulatory gray zone that is difficult to police. The information asymmetry is enormous, and American investors, however sophisticated, have limited ability to verify on-the-ground realities in a market they cannot directly observe. The Luckin fraud persisted partly because the verification mechanisms that normally constrain corporate misconduct were difficult to apply across that distance. The third lesson concerns the role of short sellers. Muddy Waters and the anonymous researcher who delivered that 89-page report were not acting out of public interest. They had clear financial incentives to see the stock fall. And yet they were right. The report that many dismissed as a self-interested attack turned out to be, in its essential claims, entirely accurate. In markets where fraud can hide, the people who profit from finding it sometimes provide an indispensable function. What does it mean when a company can commit fraud on a scale of hundreds of millions of dollars, crater its own stock price, harm thousands of investors, pay its regulatory fine, restructure its debts, and then continue to grow into one of the largest coffee chains on earth? It means that in some markets, and under some conditions, fraud can be recovered from. Not forgiven, and not forgotten, but survived. The executives most directly responsible for the scheme faced serious consequences. The investors who trusted the story faced consequences too. But the brand, the stores, the cups of coffee, the app on millions of Chinese smartphones, all of it continued.